I'll be handling unit trust fund, which is basically a collective investment scheme. Yeah, I have a brief presentation for you guys just to help you better understand this investment scheme, which is unit trust fund. So, okay, just to begin all that, it's important to note that it's not how much money you make, it's how much you keep. You'll be making a million, but at the end of the month, how much do you have as savings? How much do you have as investments? You know, it could be through insurance, it could be through a circle, through a bank. Yeah, so it's how much you keep and not how much you really make. So just a breakdown on different investment avenues. Probably majority of you guys know we have quoted securities, which are equities listed on Nairobi Stock Exchange. So you can purchase an equity. The minimum shares you can, for a specific counter, the minimum number of shares is 100. So depending on the number of shares or the amount you wish to invest in, you'll be able to purchase an equity through NSE. We have properties. I believe someone will also be talking about rates. So you can also purchase property as an asset, as a tangible asset through, it could be through rentals, commercial buildings. It also could be a plot. Yeah. We also have government securities, which entails the T-bills, the treasury bills, and the government bonds. Yeah, T-bills are more like an investment of 3 months, 6 months, or 1 year, and government bonds are majorly 1 year and above. Could also get to like 20 to 30 years. We also have bank deposits. Yeah, you can fix your money with a bank. But now there's something that maybe majority of us are getting to understand, and it's called a collective investment scheme, whereby basically rather than having a portfolio of shares with a stockbroker, and then you're holding a bond directly to CBK using a CBK CDS account, and you also have a bank deposit. You're managing all the three assets as an individual. Now there's an avenue called a collective investment scheme, whereby we are able to pull funds from different investors. It could be retail, corporate, circles, yeah. So we pull these funds and then we invest in a variety of assets. So it could be equities, it could be bonds, it could be banks. So if you have invested, let's say like 50,000, your 50,000 is holding what? If you have a money market fund, for instance, your 50,000 is holding a chunk of government bonds. It's also holding some bank deposits, yeah. If you're holding an equity fund, or you've invested in an equity fund, which is also a collective investment scheme, your fund is holding equities. So it could be Safaricom shares, we have EADL, we have KCB, a number of securities. But now, since it's a collective investment scheme, the fund is managed by an investment manager, that is like Madison Investment Managers, and then the funds are held by a separate corporate entity. In our case, we have Equity Bank, and now it's the operations of the fund manager or the investment manager are overseen by a separate corporate entity by the name of corporate trustees. So just to break down what I meant by all that, unit trust funds, it's a collective investment scheme where funds from many investors are pulled together and invested as one. So as I had earlier explained, we as investment managers, we pull funds from different investors with similar investment objectives, with similar risk appetite and investment horizon. So depending on your profile, your investment profile, we're able to guide you on which pooled fund is appropriate or is ideal to meet your needs. Yeah. So as I had also mentioned, the fund, we don't operate as an island. We have three major stakeholders. We have us as the investment managers, and then we have the custodian bank who holds the funds of now the underlying assets. Our custodian is Equity Bank, and then the funds and the operations of the trust funds are overseen by a corporate trustee. Yeah. So this is a breakdown on how a unit trust fund should look like. You as the client, we have CMA as the regulator. CMA will issue a fund manager a license to structure or underwrite a product that is a fund. It could be money market, it could be equity fund. And now the fund manager will market this product to the client, yeah, and then the client will channel the funds to a custodian bank. A custodian bank now is it has to be a corporate entity, of course, and it's a separate entity from Madison, yeah. So custodian will hold your funds, and then the trustees, they will come up with an investment policy statement whereby it states, for instance, if it's a money market fund, yeah, I will guide you further on what each and every fund represents. But for instance, if a client is interested in a money market fund, which is a conservative asset, the trustee will state that the fund, which is money market, it has to be invested in very conservative asset classes. So if you go back to now the investment game plan, we as the investment manager will scour the market to see which product or which assets are conservative. I mean, if you're maybe savvy or you're familiar with the financial space, you'll understand that government bonds are considered risk-free. Yeah, we also have bank deposits with relatively lower risk. So that is how we are able to determine which asset class to purchase in a given fund. So to give you another example, if you come on board and you have high risk appetite, you're looking to grow your wealth, you're not a conservative investor. In such an instance, we'll go back to the market, we generate a fund called an equity fund, which is basically helps you grow your wealth. So we'll invest in the quoted securities, yeah, the likes of JCB, Safaricom, and all that, with the objective of one, preserving your capital, but also ensuring that you grow your wealth. So basically, that is how it operates, and with such a structure, you will be able to see that there is zero to no chance of any of these stakeholders mismanaging your funds. Because just as I explained, the custodian is a separate entity that holds your funds. You have trustees that they safeguard the interest of the client, and then now us as the investment managers, and our role is to invest the funds that you have invested, that you have committed maybe in different funds. So just to break it down, we have a number of unit trust funds. The most popular fund is the money market fund. I believe everyone, as long as you have a bank account, you should have a money market fund. I'll explain why. We also have a fixed income fund, which is more like a bond fund, whereby rather than you going straight to CBK to purchase a bond, yeah, at the moment you want to liquidate your bond, you're not able to, get a good rate. So through the fixed income fund, we're able to purchase the bonds, we're able to hold the asset on your behalf. But now, in such an instance, you will not commit for the long tenor. If a bond is a 5-year or a 10-year bond, through a fixed income fund, you will not commit for the long tenor. So the structure of our Madison fixed income fund is a 3 months or 6 months fixed deposit, whereby the rates will also change depending on the tenor that you are putting in the funds. We also have equity fund, which is a pooled fund that majorly invests in equities, as I had explained earlier. We have a balanced fund. So from the name, you can clearly see that this is a fund with a balanced portfolio mix. So we have equities and we have bonds, yeah. And with those two, we have bonds as a risk-free asset. We have equities that is meant to grow your wealth. So with such a mixture, you're able to see that you're preserving your capital and also growing your wealth through the equities that you're holding in the balanced fund. We also have a wealth fund. I'll explain what a wealth fund is later on. So just to explain the money market fund, as I said, I believe everyone, as long as you have a bank account, as long as you have a paycheck, you should have a money market fund. Why I think that should be the case, money market fund is a better alternative to a bank account. You see how you have a current account with KCB or with Cooperative Bank, yeah? So money market fund tries to mirror a current account in the banks, yeah? What I mean by that is it's a liquid investment. You put in your money, but the moment you have an emergency and you need to access it, you're able to access it in 48 hours. Yeah. And then now that is one feature of Madison Money Market Fund. The product and the fund is liquid. You're not committing for any tenor. You can keep your money for 2 weeks to up to 10 years, depending on your liquidity requirements. The other benefit and key value feature of Madison Money Market Fund is we are offering not just Madison, all other fund managers. The returns offered in in money market fund are very competitive. If you were to compare what money market fund offers currently, Madison is offering 12.8. If you were to compare this with fixed deposits in commercial banks, you'll be able to see there is a huge variance. So the rates in money market fund are really competitive, and they are higher, I would say, from if you were to compare it with a fixed deposit. But also, as I said, it's a liquid investment. It's not a fixed deposit. So whenever you have an emergency, you can access it easily within 48 hours. Okay, so something else to note that the interest earned, it's compounded on a daily basis. So what I mean by this, if you put in an amount today, let's say 100,000, as at tomorrow, you will start accruing interest. And then the interest you've earned will earn interest. So you're earning interest of only the principal amount invested, also the accrued interest. So there's now that compounding nature of money market funds, yeah, which may not be available in other asset classes, the likes of bank deposits, But yeah, so that's why we say Madison Money Market Fund in general, it's a better alternative to a bank account. If you have a bank account and you have some funds lying idle in a current account where you're not earning anything, or you have other funds maybe fixed in a fixed deposit, you should consider diversifying. Yeah, so that one, you maintain your liquidity, and also you earn a competitive return. So these products, the Madison Money Market, it's ideal for someone who is looking to preserve their capital. So this could be someone who is retiring. You have funds, but you don't want to expose it to so much dual risk. That's why, as I said, with money market, we aim to preserve your capital, but also we ensure we're giving you returns above inflation. There's no point of you fixing your money whereby, or in an account whereby you're earning interest that is lower than inflation. With inflation at 6.8%, if your account, it could be your bank account or your savings account, if it's offering you less than 6.5, at the end of the day, you're not gaining anything. You're actually losing, your funds are actually being eroded by inflation. So we aim to preserve your capital, but also to preserve the value of the capital that you give us. If you give us 100K, and within a year, inflation was at maybe 6-7%, we will give you a return that is above inflation to ensure that the capital that you have invested in money market fund, the value of that capital is also preserved. Yeah, and then now it is also ideal for someone who is looking for a short-term parking, account whereby you invest your funds in the short run. So we have the likes of people looking to invest or save for holidays. It could be Christmas. People who are looking to invest for school fees. Yeah, maybe by January you want to achieve a certain amount of money, so it could be such objectives, investment objectives. It's also ideal for business cash flow management. If you're running a business, and maybe every quarter or every month you have inflows, of course, and you have outflows in terms of the salaries. You pay for your stock, you pay for your suppliers, and all. So for you to manage your cash flows, if you were to invest in money market maybe, and you have a huge chunk coming in early in the month, you're able to budget it, you're able to break it down as you're earning interest every day and to each and every monthly expenditures that you have. So you can access your money, as I said, very easily in the money market. Whenever you have that need, you place an order or you place that request, and you'll be able to access it in 48 hours. So the beauty with that is your funds, they're working for you, you're earning interest every day, and the interest one is above inflation, so your money is not being eroded by inflation. Too, the funds you have invested in money market are preserved because money market is very conservative. So something else to note, with money market, you can use it as an emergency fund. So what I mean by this, everyone should have an emergency fund, which entails at least it should be 6 months worth of your monthly expenditures. It could be your rent, you have school fees, you need logistic costs and all that. So your 6 months worth of expenditures should be invested as an emergency fund. So you break it down. How much do I spend on a month? How much do I need to survive for the 30 days of October? Now you multiply that by 6, and that should be your emergency fund. You invest it in money market fund. Why? Because you're earning a good return, but also whenever you have now that emergency, you have lost a job or you need your school fees and all that, you're able to access it easily, plus all the interest accrued. So something else, you can also use it as a savings plan, whereby you break down your income on a monthly basis. You want to be saving 10% of your income. So 10% of that goes to money market, and you with money market, as I said, you can top up on a regular basis. You can also access your money whenever there's an emergency. So this is how we calculate your interest on a monthly basis. For instance, with an investment of $1 million at an interest rate of 12.8%, every month you're making 10,000. Yeah. So for instance, for month 1, just to give you an illustration of how a million Kenya shillings can generate returns or can work for you. With $1 million in a bank account, you're losing out on ledger fees. You're losing out on all these transaction fees. With $1 million in money market, every day you make returns from roughly 300 shillings to 500 shillings, depending on the return being offered by your fund manager. So if you're making 300 shillings, yeah, that accrues to roughly between 8,000 to 10,000 every month. So with 10,000, that could be your fuel money, that could be your shopping money, yeah, that you're earning from the $1 million that would have maybe been sitting idle in a bank account. Yeah, if you are to compound it, or if you don't have to access your interest on a monthly basis and you compound your interest, by end of the year or by end of month 12, you'll have earned 113,000 Kenya shillings at a rate of 12.8. But also note, in between this period, whenever you have an emergency and you need your money maybe on month 12 or sorry, on month 3, you will access the million 18,000. So there are no charges, there are no exit fee, there are no penalty fees. This is not a tenor-based investment. We're not saying that you have to fix your money for 3 months for you to earn your interest, but rather you park your money and it's up to you to decide when and how much you want to access. Yeah, so just a breakdown on other funds. I believe by now you understand Madison Money Market Fund. Begin with whichever amount you have. You can start with 5,000. Minimum top up is 1,000. Whichever amount you have. Yeah, I also see other fund managers with minimums of even 1,000. So it should be, the minimum amount should not be an excuse as to why you don't have a money market fund. Yeah, if you want to have an emergency fund, you want to start your savings, yeah, you want to grow your wealth, the square A, or how I would call, how do you start your investment journey? You want to grow your wealth, you start with money market. With any fund managers, the returns are really competitive. But if you were to compare it with the conventional or the traditional bank accounts, so the minimum for Madison is 5,000. Minimum top up allowable is 1,000. So there are no restrictions on tenor. As I said, you can invest for whichever period you prefer, and whenever you have an emergency, our withdrawal turnaround time is 2 days. Yeah, so just to a brief on Madison fixed income. Fixed income fund, as I said, it's a bond fund. If you want to invest in government bonds, but you don't want to commit for the long tenors, you can purchase the bonds through a fund, through a pooled fund, CIS fund. So with that fund, the underlying assets are government bonds and the treasury bills. So which would mean that the product is very conservative, the product is very safe and secure, as government securities are considered risk-free assets. So the minimum for the fixed income fund is 5,000 and the minimum top up is 1,000. So if you want to invest in, for instance, a government bond, you have to commit your funds for like more than a year. But with the fixed income fund, you are only required to commit your funds for only 6 months. After the 6 months, you get to access your capital plus all the accrued interest. And then the moment you have an emergency and you need to also access your funds within 4 days, you're able to avail it. Yeah. So the other fund is called a wealth fund. So this majorly targets individuals who have already saved in the bank. They have more than a million. The minimum is a million Kenyan shillings. You have a million, and you're looking for ways to grow that 1 million. You don't want to access your money, so you don't want it in money market fund. You're, yes, a conservative client, but you're also looking to grow your wealth. So with Madison Wealth Fund, our return is at 14%. We ensure to, one, preserve your capital, but by you committing for a certain tenor, the 6 months, you see, for money market, you've not committed for any period. But for you committing, if you commit for 6 months, we'll give you a better rate, because also for on our end as the investment managers, we're able to negotiate for better rates for you, since we're locking it for 6 months. So as you basically know, the longer the period you invest your funds, the higher the returns you earn, and the higher the amount you invest, of course, the substantial returns that you'll be getting. The other product is a segregated fund, which majorly it's a solution that targets corporate. The minimum investment is 30 million, sorry, and the returns can get up to 16%. Yeah. So just to give you, maybe to my parting shot is, as you, most of you are well aware of the 50-30 rule, 50-30-20 rule, whereby 50% of your, it could be your employment income, it could be income from business. So 50% should at least, okay, at most, 50% of your income should cater for your basic necessities. That could be your rent, your school fees. Yeah, it could be other necessities that you require for you to stay alive. You have 30% which can cater for your wants. Your wants can also be you financing your loan, financing your debt. Yeah, and then 20% should be channeled to a savings and an investment account. So savings and investment account, as I said earlier on, it could be anything from purchasing an asset itself. It could be equities, a property. It could be bonds, yeah, and an insurance policy, but also a conservative investment like a collective investment scheme. So 20% of whichever amount you're earning. So which would mean everyone with an income, either from employment or a business that you're running, everyone can afford 20% of that, channeling it to a savings account. Yeah. So basically that is all